Hello everyone, we are from Group 3 and we are going to present about Topic 3, the money market.
In our group, we are five members myself, Ramiyah Tamilchelvan, Kumareshwari, Lamanya, Angleshwari, and Lu Chen Tao.
Hello, this is the money market concepts. The money market is basically a part of the financial market where financial instruments with high liquidity and short time maturities are traded. This is a money market characteristic. The first is they are relative safe, and the second, they are extremely liquid, and lastly, they are insured and a discount to their face value. This is the money market structures. Uh, only have two structures. One is Islam market and another is traditional markets. That is all. Thank you.
Good day everyone, my name is Ramiyah Tamilchelvan. My metric number is 264268, and today I am going to present about what do they trade in money market. The money market refer to the trading in very short-term investment at the wholesale level. It involves large volume trade between institution and the traders. At the retail level, it includes money market mutual fund bought by individual investor and the money market accounts opened by the customers. Larger corporations with short-term cash flow needs can borrow from the market directly through their dealer, while small companies with excess money cash can borrow through money market mutual fund. Individual investors who want to profit from the money market can invest through their money market bank account or a money market mutual fund. A money market mutual fund is a professionally managed fund that buys money market security on behalf of individual investors. There is a lot of instrument which trade in the money market. Today I'm going to present some of it. The first instrument is Bank Nagara Monetary Notes. Bank Nagara Monetary Notes are securities issued by the Bank Nagara Malaysia replacing the existing Bank Nagara bills for the purpose of managing liquidity in conventional financial market. The maturity of these issuance has been lengthened from 1 year to 3 years. New issuance of Bank Nagara Monetary Notes may be issued either on a discount or coupon bearing basis depending on the investor demand. Discount-based Bank Nagara monetary notes will be traded using the same market convention as the existing Bank Nagara bills and the Malaysian Treasury bills. While the coupon-based Bank Negara monetary notes will adopt the market convention of the Malaysian government securities. The next money market instrument is Malaysian Treasury bills. Malaysian Treasury bills are short-term security issued by the government of Malaysia to raise short-term fund for the government's working capital. Bills are sold at the discount through the competitive auction facilitated by the Bank Negara Malaysia with original maturity of 3 months, 6 months, and 1 year. The redemption will be made at the par. Malaysian Treasury bills are issued on weekly basis and the auction will be held 1 day before the issue date. The successful bidder will be determined according to the most competitive yield offered. Normal auction day is the Thursday and the result of successful bidders will be announced 1 day after. Malaysian Treasury bills are the tradable on yield basis discounted rate based on bands of remaining turnover. Example, band for equals to 68 days to 91 days to the maturity. The standing trading amount is RM 5 million and it's actively traded in the secondary market. The third money market instrument is Malaysian government security. Malaysian government security are long-term bonds issued by the government of the Malaysia for financing developmental expenditure. Malaysian government security are fixed rate coupon bearing bonds with the bullet repayment of principal open maturity while the coupon payment are made semi-annually. Beginning December 2016, Bank Negara Malaysia has introduced callable bank Malaysian government security which provide the government of Malaysia with the option to redeem the issue at the par by giving an advance notice of 5 business days to the bondholders. Typically, the issue will be called in the whole on the specific coupon dates. However, this characteristic may be vary in the future. Both MGS and MGS callable are issued via competitive auction by the Bank Negara Malaysia on behalf of the government. The successful bidder are determined according to the lowest yield offer, and the coupon rate is fixed at the weighted average yield of successful bids. The government is committed to continuously issue 3 years, 5 years, 7 years, and 10 years NGS as benchmark security as part of its effort to develop the benchmark yield curve. Money market instrument is negotiable instrument of deposit. NID are deposit certificate used in the wholesale money market that are regularly purchased and traded by institutional investor and high net worth individual in the stock market. Retail NIDs works like fixed deposit where the investor have the choice of depositing their money for the fixed period of time to generate a higher interest rate than those offered by the bank for fixed deposits. Retail investors are individual and eligible small and medium enterprise. Bank Negara Malaysia introduced the retail NID, so the retail investor can have another savings option while banks can have additional source of capital to help them better manage their liquidity profiles. The last but not least is banker acceptance. Banker acceptance is a bill of exchange driven by the customer and accepted by the bank to finance their related purchase, import or sales or export of goods from to the resident or non-resident, supported by the adequate documentation evidence the movement of the good between the transact parties. The operation of the banker acceptance is that subject to the prevailing guideline on the banker acceptance issued by the Bank Negara Malaysia. Minimum period of financing is 21 days and the maximum period of the not exceed the approved financing tenure per the letter of offer, subject to the maximum period of 365 days.
Hi everyone, it's me Treasury Murugan. My metric number is 264563. Now I'm going to talk about my part, which is money market trading practices. There are many different practices for trading different instruments in money market. Let's see two examples of instruments and its practices. The first is banker's acceptance. Well, let us see the creation of BA. The BA is drawn by a customer on his bank to finance its either export, import, domestic sales, or domestic purchase. The bank will issue the BA at a discounted price. Bank will lend money to its customer by keeping the BA. The bank may keep the BA till maturity, or the bank may sell the BA to a potential investor by rediscount the BA. By selling the BA to investor, the bank will obtain funding for the BA. On redemption day, if the bank owes the BA, the bank will surrender the BA to the customer in exchange for the face value. As a result of this, the bank will get discounted income. If the bank sold the BA to an investor means the investor will redeem the face value of BA from the bank. Then the bank will surrender the BA to the customer and get payment from the customer. In addition, the investor who purchased the BA from the bank can sell the BA to another potential investor, and the other investor also may sell the BA to another investor. All of this is possible before the maturity. On maturity, the last investor who holding the BA will surrender it to the specific bank and get the face value of the BA. Then the bank will surrender the BA to the customer and get payment from the customer. I hope that the money market trading practices of BA has already makes clear. Let's go to the second instrument, repurchase agreement, which is called as repo. A repo is an agreement whereby a bank sells its valued money market papers to an investor with an understanding to repurchase them at an agreed price on a specific future date. The type of money market papers normally used for repo include banker's acceptance, negotiable certificate of deposit, and Malaysian government stocks. On day 1, investors who include private public companies with surplus funds, government agency with surplus funds, and cash-rich individuals will place their surplus fund with bank on short term. Then, the bank will pledge money market papers for the tenure of replacement to the investor. On maturity day, the bank will return the investor's principal plus interest. The investors also will retain the right of claim to the money market papers. This report rating enables investors to maximize returns on short-term surplus funds rather than leaving the funds idle in current account which yield no return. This is what money market trading practices on repo. Now let's see about money market trading practices during rising and falling interest rates. When interest rates are rising, the investor will keep their maturity short such as maturing in 30 to 90 days. This allows the investor to reinvest their money at higher rates when their T-bills and CDs mature. Bankers' acceptance and commercial papers are generally not available in amount the average investor can buy and mostly bought by large institutions. Another practice that investors do is ladder their investments. They will buy 30-day, 60-day, and 90-day maturities, and as each matures, reinvest the money in a 90-day maturity. This way, the investor has monthly money maturing for reinvestment at higher interest rates. Laddering can be done to maximize their return by spreading their laddered maturities out to 6 months or 1 year in equal amounts to take advantage of higher yields available in the longer maturities. As rates rise, the dollar value of their investments falls. When the BNM announces plans to lower their interest rates, the investors will buy the longest maturities. This locks them into the highest interest rate available at the time. If they have later their investment, they will reinvest their maturities in 1 year or longer maturities. Reinvest their maturity. This is also a standard practice of money market mutual funds managers. Bank CDs normally pay higher interest than T-bills, and investors can more easily buy them to match the maturity dates they want. Some banks also offer laddered CD package when interest rates are low. When interest rates start to rise, banks want to keep their cost of funds low, so they offer attractive long rates to lock in expensive money for longer periods before market interest rates hit their peaks. Then, when interest rates start to decline, they offer attractive short-end rates to attract money that will roll over at even lower rates. Thank you. That's all from me.
Hello sir, my name is Lavanya, daughter of Saravanan, and my matric number is 265097, and I will present for risk in money market operation. To start with, I will tell money market funds are open-ended fixed income mutual funds that invest in short-term debt securities, for example, debt instruments in the bank that come with low credit risk and also emphasize liquidity. As I know, the lower the maturity date, the lower the risk taken by the investors. So in money market, when it says money market usually typically money market securities come with maturities under 12 months. The short-term nature of the securities is a way of reducing risk and also uncertainty. As I said earlier, the lower the maturity date or maturities of the securities, the lower the risk taken by the investors in money market. So the selection of money market investment is performed by a fund manager, as it should relate to the type of money market fund. The type of money market influence the risk taken by the investors. Money market funds are not insured by the federal government. Somehow the money market accounts are insured. So it is basically risk being involved in the insured by not insured by the federal government. Other than that, money market mutual fund income is usually in the form of dividend, and it can be taxed also, not it can be exempted, but it all depending on the nature of securities that had been invested in the fund. For example, the type of investment that being invest by the investor is important when it comes to determine the risk taken by the investors. So there are objectives of money market fund investments. Investors take part in money market funds for certain reasons. One of that is short-term investment horizon. Secondly, low conservative risk appetite with preference, and low security volatility, high liquidity needs, and also low returns, which is compensated with low risk, and also stability and certainty. Where the money market investments are basically a low risk investment which attract the money market investors to invest in money market, because the short term, for example short term, the low risk and then high liquidity, which attract the investors. Money market funds act as a risk management tool, as funds are invested in cash equivalent securities with low risk and high liquidity. So this is what attract the investor, but somehow there are risks involved when it comes to money market operations. So as I say, the money market investment maturities over 12 months, and it comes with low risk and high liquidity. Somehow there is certain risk that involved in money market operations. So firstly, it is credit risk. Money market securities susceptible to volatility, and it is not insured by the federal government. Hence, the potential to not lose money, however, is low, but somehow it is not guaranteed. There is exist of probability of loss, although it is generally quite small. Like, there is no guarantee the investor will receive per share on the redemption of their shares, because when it comes to money market securities, it is not guaranteed, because the federal government are not insured by the money market instruments. Secondly, the risk involved is low returns. The low returns of money market funds are usually lower than other funds comprising of assets such as stocks and properties. There is a chance that money market returns may also fall below the inflation rate, providing negative fall below the inflation rate, providing a lower returns to the investors, which means inflation risk involved in this matter. Interest risk can also go down further, reducing the returns on money market investments, where the low returns sometimes involved in this money market operations. Other than that, risk involved is liquidity fees and redemption gates. It involves the imposition of liquidity fees. For example, fees levied on the sales of the shares, like redemption gates require waiting periods before normally implemented to prevent run on the fund in periods of market stress. So that's liquidity fees is considered a risk in these money market operations. So the next risk the money market investors could be exposed to is foreign exchange exposure. This is because this risk is borne by funds that invest in money market instruments across borders that are denominated in other currencies other than the home currency, which is basically means that there are also other currencies involved in these money market operations, where the value does not will remain the same. There will be changes in the value depending on the market. So it is important for the investors to know about the foreign exchange exposure, because it is exposed them directly when it involves other currencies. The next risk is environmental changes. The environmental changes in economic policies and government regulations can result in adverse impact on the price of money market securities and their issuers' financial standing. For example, if they affect in the interest rate and the money supply, it basically considered as environmental changes. So it is important to investors to know about the current environmental changes, because it also influence the money market instruments risk. So I think that's all from me. Thank you, sir.
My name is Segaran and my metric number is 264533. Now I am going to explain about rights of each parties in mentioned money markets. First of all, government has the main rights to amend Schedule A, which is statutory acknowledgement receipt, or Schedule B, which is statutory monthly statement. As for the bank negara Malaysia, they have rights to request, inspect, and make copies of information needed. Whereas for the investors, they have rights to be paid on schedule or when it's due. And this all describes that can be seen in the Act 188, Treasury Bills, Local Act 1946. Thank you so much everyone. We hope we gave a good explanation about the money market. If you all liked our presentation, don't forget to give a like and share to your friends. If you want further explanation, do not hesitate to ask us in the comment section below. Thank you.